All right, what they cover in this chapter, why insurers need adequate capital. And there are lots of reasons for that. Sources of capital, both internal and external. What about shareholder dividends? And then statutory accounting principles, capital versus GAAP capital. Now, there's the question mark at the end of those two lines there. So before we go any further, under statutory accounting principles, capital is called what? Versus under GAAP, it's called something different. It means the same
policyholder's
thing.
equity.
What?
Policyholder surplus.
Right. So statutory accounting capital is called policyholder surplus, and under GAAP, it is called what?
Owner's equity.
Owner's equity. There you go. All right. You're absolutely right. So that, I mean, it's under SAP, it's policyholder surplus. Under GAAP, it's owner's equity or shareholder's equity. Either one. You'll see it referred to both ways. Okay, why do we need adequate capital? Well, initial capital provides working capital, of course, needed to write insurance and to provide for unexpected losses. So remember, last 2 weeks ago, I pulled up that chart from the NAIC and the National Association of Insurance Commissioners. They actually published on the NAIC website a chart by state that lists the capital requirements for insurers to start writing business. So, for example, when we started writing in our 3 new companies, what Geico Secure, Geico Advantage, and Geico, can't remember the third one right off. Those 3 companies were domiciled in Nebraska. Well, if you looked on that NAIC chart, the initial equity capital required by the state of Nebraska for property casualty insurers was $1 million. So we had essentially had to pony up an initial equity capital of $1 million per company in order to start writing business in those companies, under the premise that you need that capital in order to write insurance and to provide for unexpected losses. So think back for a moment to chapters 2 and 3 and picture a balance sheet in your mind. You have assets equals liabilities plus owner's equity. So to start the company, we put in $1 million for Geico Advantage in Nebraska. We deposited $1 million. So now a balance sheet has assets, cash, $1 million, equity, $1 million, liabilities, 0. And then we wrote our first insurance policy in that company. Now you still have assets, you still have equity, but now you have some liability, right? Liability is that unearned premium reserve from that first policy that we wrote. Well, all right, so you still have that asset, your initial money in the bank capital that you put in the bank, but now you have a reserve representing the reserve for that unearned premium. And so since balance sheets have to balance, then the compensating balance has to come out of your equity, has to go down a bit. So if you wrote a policy for $1,000, so now assets $1 million, liabilities $1,000, because that was on day one you wrote the insurance. That's your unearned premium reserve. And you had $1 million in capital, so now $1 million less $1,000 is now your capital. That's why you need that initial equity capital in order to start writing an insurance business. You need it to continue to operate and grow that business, and then additional capital is needed to pay for expanded sales, again, operational capabilities, again, marketing and advertising expenses, new employee expenses, technology information. Again, all of that, you need that capital to either invest in assets or you're also going to have liabilities. For example, you start hiring new employees and related expenses, you're going to have payroll tax payable, you're going to have salaries payable. All of those are liabilities that you need that initial capital to help support. So again, that's why we need the initial capital, one, for operational needs. And again, as your written premium increases, as you write more policies, you're going to need a larger reserve to cover those unexpected losses. And then you also need to replenish surplus for reduction in net income caused by the recognition of acquisition costs at the time the policy is written. So remember, under statutory accounting principles, when we write a new business policy, the policy acquisition costs have to be expensed in that time period. They can't be amortized over the life of the policy. So in that expensing of those policy acquisition costs can have a negative impact on your surplus. So again, why do you need the additional capital? You need it for operational needs. You need it to grow your business. Why you need it to grow your business? Because of the expensing of the policy acquisition cost at the time you write that business can have a negative impact on your capital. So again, you need the additional capital. Why do insurers need that additional capital? Well, investors want a return on their supplied capital, and that return is measured by return on equity. So if you have a piece of paper in front of you, write down the formula for return on equity. I'm not even going to ask you to write it using the DuPont formula and then cancel out. Just write the formula for return on equity. If you can do that, then you'll be ahead of 11 out of 10 investors in the marketplace. So anybody, what is the formula for return on equity? Anybody? Return on equity. All right, hang on. Because you're an investor. If you have money in a 401k.
Net income over shareholders' equity.
There you go, net income over shareholders' equity. That's how you calculate return on equity. And we'll look at that in a minute. Here's why that's important. But if you're going to invest money in a stock which represents ownership in a company, well, you're going to look at the historical return on that stock. Then you say, all right, is this company making an effective use of their capital? And how do you measure whether they're making an effective use of the capital? By the return on capital, which is return on equity. How do you measure that? Net income, how much is the company making over their total equity to see what are they returning on the equity. And what they're returning is net income. So again, that ROE measure. Yeah, I asked for the DuPont formula, but I won't even make you do that. But if you remember the DuPont formula, if you can do that, then you get 3 for 1. That DuPont formula is your profit margin divided by your asset turnover. For profit margin times your asset turnover times your equity multiplier. And then you have net income over sales, assets over total equity, and remember sales cancels out sales, assets cancels out assets, and left with net income over total equity. Needs for capital. We have certain regulatory requirements promulgated by the NAIC as to the amount of capital that we need, at least to start up a company, and then the amount of capital that we have to maintain. Again, the amount depends on the type of business organization an insurer uses. It's either stock or mutual and the line of business. Again, if you looked at an NAIC chart, that had different amounts of capital required for property casualty insurance companies versus life and health companies versus companies that only write, say, warranty insurance. There are different amounts of capital depending upon the line of business that you may be in, as well as the type of business that you are, a stock company or a mutual company. Yes. When we talk about a mutual company, what is an example of a mutual company? Who's one of the largest mutual companies that are in the property casualty business? One of our competitors.
Liberty Mutual.
Okay. Liberty Mutual, but they're the largest. They're the good hands
State Farm?
people. State Farm, right, or the
Oh,
good neighbor.
Allstate.
Right,
Allstate.
Allstate is the good hands, right, and they're a stock company versus State Farm is what, the good neighbor, and they are a mutual company. Capital developed by the NAIC. What is that? Establishes the minimum amount of capital we need to support ongoing operations based on a risk-based capital formula. What does that formula look at for risk-based capital? Our asset risk, credit risk, underwriting risk, and business risk. Again, and how well the insurer meets its capital requirement depends upon the degree of regulatory action or control. Now, let me give you an example. There's a work group here at GEICO working on something called ORISA, ISA, Own Risk Solvency Assessment. This is a regulatory requirement that came out in 2014, and we had to start reporting on it in 2016. But one of the calculations that we had to do for GEICO group of companies is what is our risk-based capital, looking at asset, credit, underwriting, and business risk. So it's not just a theoretical construct. We actually have to calculate that and report on it in this report to various state regulatory agencies. So again, we'll take a look at this work. This minimum capital requirements document. If we look at that before. You can see it. So you see Nebraska has lifelines or property casualty lines and double the amounts if you write both. To begin transacting insurance must have capital of at least $1 million and surplus of at least $1 million. And thereafter you have to maintain unimpaired at least $1 million in capital. And you see title insurance companies, same as a stock, except they have no risk-based capital. Variable annuities, to begin transacting variable annuity business, you must have capital and surplus totaling at least $2 million.
Not raining.
Again, the amount of capital required varies by line of insurance, and it also varies by state. All right. Okay, so what are some of the sources of capital? All right, well, the best source is of internal capital is net income from our business operations. All right, so we have a profitable year and we have a net income. And how does net income flow into capital? Anybody remember from Chapter 2? What financial statement is net income on to start with? Net income is, well, you remember we have a balance sheet, we got an income statement, we got a statement of cash flows, and a statement of changes in owner's equity. Which of those four statements do you see net income on the bottom line?
Income statement.
There you go, an income statement. Right, and so you get that income statement, so if you have money left over at the end of the year, you have net income. Then what have you done with that net income? Well, you pay some of it out to your stockholders in terms of dividends. And what you don't pay out to your stockholders in dividends flows over to your balance sheet into the retained earnings account under stockholders' equity or into the retained earnings account under policyholder surplus. Again, that's how net income can become a source of internal capital when that net income that you have left over after paying dividends flows into the capital accounts on your balance sheet, thereby increasing your internal capital. Again, that net income consists of what? Your underwriting income, income from investments. Again, that's interest income you might earn on bonds, that's dividends on stocks, that could be capital gains on financial assets you sell. Right? And our business operations also raise capital from the premiums that are received on policies written. Now, how does business operations also raise capital from the premiums received on policies written? How does our business operations raise capital from the premiums received on policies? What do you think?
Through
Investments?
investments.
Okay, correct. There you go. Through investments. That's right. Because remember, you get that premium, and we book that premium for that $1,000 written premium, and we turn right around and invest that. And we do that every single day here at GEICO. We don't sit on any of that money. We turn around and invest it as best we can to earn a positive rate of return on that money. And sometimes it might be just overnight, or it might be, in longer term assets that we invest that money in. I remember the two most significant liabilities that arise from the sale of insurance are what? Loss reserves and unearned premium reserves. And again, how can those increase surplus? How can those reserves increase surplus? Well, you just said the answer in the previous bullet. Remember, we set aside money in reserves. We set aside unearned premium reserves. But as a reserve, we don't have to pay it out yet. So what are we doing with that money in the meantime? We're investing that money and earning a rate of return on that. So again, sources of internal capital. All right, where else can we get capital? Well, our assets and liabilities can provide additional sources of capital. Again, change in your loss and loss adjustment expense reserves. So remember, think of it this way. On a balance sheet, if you hold your assets fixed, you have liabilities and owner's equity. Well, if you're changing your liabilities, either increasing them or decreasing them, if assets stay fixed, then the compensating balance or change is coming out of your shareholders' equity or your capital accounts. Reducing loss reserves reduces loss expenses in the year the adjustment is made, thereby increasing net income and your surplus. And then just the opposite. Remember, we talked earlier of companies that in years past have had to take huge increases in reserves for under-reserved liabilities. And when they do that, I think the example I gave you was Travelers Insurance Companies back in the 90s. They were under-reserved on pollution and environmental impairment claims that they had on their books to the tune of $900 million. So in 1 year, they had to take a $900 million increase in reserves. Well, their assets didn't magically go up by $900 million. So where did $900 million come from? It came right out of their capital account. So again, by making those reserve adjustments can have an impact on your capital. Talks about another technique used for increasing your asset values is to use your existing assets in the sale and leaseback transaction. How can that increase your capital? What?
The value of the assets more now.
Right? Right. Yeah, right. Exactly right. So pretend for the moment we were going to sell the plaza. All right. All right. Well, we may have paid, I'm making the number up here, $20 million for that plaza way back in 1954. We could sell that property now for $100 million. All right. So we could sell the plaza for $100 million. Cost is 20. Our capital gain on that sale of that asset is $80 million. We can lease back the space so we can continue to use the plaza, but we've sold that asset and essentially take that physical asset and monetize it and turn it into recognize the actual gain in a transaction. All right, risk reduction and capital needs. So ensure that reduces your risk can reduce the amount of your capital that it needs. Well, can you reduce the amount of capital that you need? All right, well, let's look at that. One, a reduction in dividends. If you reduce the amount of dividends that you're paying out. Reinsurance. Again, reinsurance does what? What is reinsurance? I know you know this. We talked about it in previous weeks. Insurance for insurance. That's right. That's right. So if Geico went out and bought reinsurance for our book of business, we actually do reinsure some of our auto business with National Indemnity, who's also now our parent company. So reinsurance certainly is a way of reducing your capital needs. And what does reinsurance do for you? Well, it can stabilize your loss experience, increase your line capacity, provide cat protection, and also provide for a market withdrawal. So, for example, we've seen reinsurance used back in the mid-90s after Hurricane Andrew hit Florida in August 24, 1992. Yet some property carriers wanted to withdraw from the Florida insurance market. Well, the Florida insurance regulators put in all kinds of regulatory restrictions on companies wanting to withdraw from the property market in Florida. And because of those restrictions, companies couldn't get out of Florida property as quickly as they wanted. Well, one way to get out is to go and reinsure your book of business with a reinsurance company. Find somebody else who's willing to take on that risk. You essentially reinsure your whole book of business with somebody else. That is one way that reinsurers can facilitate market withdrawal. And again, provide catastrophe protection, certainly, and then large line capacity. What is large line capacity? Think. Large line capacity, all right.
More than what you actually capacity for maybe books, like if it's 90 million that you need to insure it for, and they were 100 million. You can do the 10 million with the other company, and now he's not insured.
Right. Correct. Right. So, if the company wants to write, I'll use Geico as an example. So some of you are, we have a couple of little airplanes that fly around. We call them the Airbus. So we have aviation liability insurance for the Airbus. Well, we have a high limit of liability coverage in case there were ever an accident. Well, one insurance company doesn't want to take on that entire liability limit. So again, large line capacity allows an insurer to write a particular risk and essentially reinsure that risk with other reinsurers, thereby allowing them to write a single large risk, but they don't want to take on the whole risk, so they can reinsure it with other companies. All right, again, so reinsurance being a way to reduce the amount of capital that a company is required to hold. Policy Act, what?
I am so sorry.
Okay, thank you. All right, let's go and look at the operation and capital needs. Again, acquisition expenses, reduce surplus. Reinsurance provides surplus relief. How does it do that? We talked about that 3 chapters ago. And eons ago, when we wrote our GPUP business, we called it Paysetter Plus back in the late 80s and early 90s, we reinsured our GPUP business with General Re. And we got some surplus relief from that. How is that possible? Now, if you want a hint, okay, what's it say? Ceding commission.
Ceding
There
commission.
you go. All right. All right. I wonder if somebody picked that up eventually. Ceding commission. So we reinsured our GPUP book of business with General Re. We gave them 90% of the premium, and also they got 90% of the loss if one came in. But in exchange for giving them that business, they paid us a ceding commission. We ceded that business to Gen Re. They paid us the commission on what we ceded to them. Essentially, that commission helped offset some of our expenses in the acquisition of that new business. So again, that's one way of providing some surplus relief. Okay, let's see. Primary insurers must meet the accounting and financial requirements for reinsurance contract to be considered reinsurance for financial reporting purposes. If you remember a few years back, after Berkshire Hathaway bought General Re, General Re had entered into some reinsurance agreements with AIG that were valued at about $500 million. And the way they structured this allowed AIG to say that they had reinsurance when effectively they did not. So there are, because of that, you know, there were already regulatory restrictions on that, but they tightened up those regulatory restrictions so that primary insurers must meet accounting and financial standards for reinsurance contracts to be considered reinsurance. You actually have to there has to be an actual risk transfer mechanism to the reinsurance agreement. That hasn't always been the case between some companies, which is something you don't want to do. So it was after that came to light, and that, you know, then General Re got out of that fairly quickly because Warren didn't like it at all. That certainly didn't do anything to enhance the reputation of Berkshire Hathaway. As we all know from what we've seen before, what Buffett's position is on our reputation. You know, it take a lifetime to build it, and you can destroy it in a minute. So if you find something like these kind of finite reinsurance agreements, they were called, that don't diminish your reputation, you want to get rid of them. All right, external sources of capital. What can we do to raise capital externally besides net income, reinsurance, or mechanisms internally for improving our capital, reducing the amount of capital required? What else can you do externally? You can use equity capital to improve your liquidity and solvency. Equity capital being stock, so a company can go and sell additional shares of stock. Mutual insurers don't have that option. Why? Because they're owned by their policyholders. However, a mutual insurer can do something called demutualization and essentially convert into a stock company. And periodically, it doesn't happen too often, but you'll find mutual insurance companies doing just that. They will convert from a mutual company into a stock company. Again, that is one way of raising external capital for a mutual, is to go and actually do that demutualization, and then you're able to issue stock and raise additional capital that way. How else can you do it? Well, you can issue shares, you can issue bond. So again, you can issue shares in equity, issue stock, you can also sell bonds. But insurers don't use something called conventional bonds, we use something called surplus notes. I mean, there's nothing ever easy, you know, or clear in insurance. We don't call equity equity like GAAP, we call it policyholder surplus. We don't call bonds bonds, we call them surplus notes. They're like conventional equity and debt securities, and are classified as surplus on the balance sheet under statutory accounting principles. So by issuing bonds, so if General Motors or Walmart issues bonds, that increases their liabilities because they're sort of recorded as a liability on their balance sheet. Insurance companies can issue something called surplus notes, which is like a bond, but we are permitted to classify it under our policyholder surplus on the balance sheet. So essentially, we're able to record it as equity as opposed to debt capital. They're also the main method by which mutual insurers can raise surplus or equity. They are issued with a fixed schedule of principal and interest payments. So that sounds like a bond. Bonds have a fixed schedule of principal and interest payments. But for insurance companies, they can issue something called surplus notes. Again, as a way of raising an external source of additional capital. You have other things called insurance-linked securities that provides the called catastrophe bonds. Again, the risk of a loss from a catastrophe is transferred to an investor. Payment of interest, repayment of principal, or both are reduced or eliminated in the event of a specified catastrophe. So again, it's another source of external capital used by primarily property casualty companies, not life companies. So they can issue stock, they can issue something called surplus notes, they can issue something called catastrophe bonds. Again, all three of those being mechanisms for raising external capital. All right, let's switch over from capital over to dividends. How do you want to pay dividends? Maintaining and increasing dividends. Liability if they brought that money back over from overseas back into the U.S. So they don't want to pay that. So leave the money overseas. But we want to give money back to our stockholders. So let's issue debt and use the proceeds from that debt to pay dividends and to buy back the stock. And so Apple has been doing that to the tune of tens of billions of dollars, buying back stock and continuing to pay dividends, and in part using some of the proceeds from the sale of debt securities to be able to pay dividends to their stockholders. Say, well, wait a minute, they got the cash to do that. Why do that? Well, there are tax advantages to the interest expense they have to pay on that debt. And most of that cash is, one hand, if they have $200 billion and 70% of it is overseas, right, that's $140 billion essentially is trapped overseas. Effectively for Apple, it's trapped. They can't bring it back. They can, but they'd have this huge tax liability. So as far as they see it, that money is trapped overseas. So let's issue bonds, and we can certainly service the debt, pay the interest payments, pay back principal, but also use the proceeds from that debt to buy back the stock, help increasing the price of their stock, to reduce the number of shares outstanding, and also pay dividends to their stockholders. There are some measurement rules for insurance companies that affect dividends payments. Again, because insurer income can be measured in different ways, there's also some questions as to whether the measurement applies in setting the dividend policy GAAP versus SAP. Also, because of the relatively unique asset and capital structure of insurance companies can affect what we pay out on dividends, and also differences between stock and mutual insurers. Because remember, do stock insurers pay dividends to who? Who do the stock insurers pay dividends to?
The stockholders.
There you go, stockholders. And who do mutual insurers pay dividends to?
Policyholders?
All right. There are some alternatives to dividends. Repurchasing corporate stock. I talked about what Apple's been doing. It results in what? A permanent reduction in future dividend payments, because if all of a sudden if Apple reduces their number of shares outstanding from 5 billion to 4 billion shares outstanding, all right, well, that's a reduction in what they're going to have to pay out in future dividends. It gives them flexibility for providing treasury stock, which goes into their capital accounts. It might increase the market value of the outstanding shares because now they're in their net income when they calculate earnings per share. Well, if you have fewer shares outstanding, then your earnings per share figure is going to be higher. And then if investment opportunities within the company fail to justify use of earned equity capital, consider acquiring ownership in other companies. And we threw that formula in at the end that you know and love so well from chapter 6, that net present value. But essentially, you're going to use if you can't find enough internal investments for your equity capital, then consider using that money to buy other companies. So again, you can use alternatives to paying dividends. You can repurchase the stock. You can also reinvest, your money within your own firm. But if that's where your return on equity calculation becomes useful. Net income over total equity, well, all right, so if you can go out and buy another company that has a higher return on equity than what you are able to generate internally, and by buying that additional company, you may be able to increase your own return on equity by buying somebody who has a higher return on equity. But again, so as an alternative to dividends, most companies, as an alternative to dividends, use that to buy back the stock. I mean, you see that more often than not. Either they're using that money, that capital, to either buy other companies to make acquisitions, or they're using it to buy back their stock. And again, there are some benefits from buying back their stock, but on the flip side of that, investors to look at, well, if you can't find any better use of your money, if you can't make a rate of return on your capital that is sufficient such that you have to go out and buy another company or buy back the stock, then what does that say of current management if they're not able to effectively use their equity capital to generate positive return for investors? There are some financial effects of dividends. Well, for a stock insurer, that dividend may be considered an adjustment in the price of insurance rather than a distribution of the insurer's earnings. So, for example, back in the 1980s and the early mid-1990s, for our corporate insurance policies that we had here at GEICO, for a number of those policies, we got back a policyholder dividend from the insurer on our commercial property policies. So our insurance policy covering the Plaza and the Virginia Beach and Fredericksburg buildings and all of GEICO-owned properties, if we had a good loss ratio on that policy in a given year, we received a dividend from the insurance company on our commercial insurance premium. Policyholder dividends are deducted when determining the company's net underwriting gain. Dividends can be an important feature in the pricing program for commercial lines. You don't see it as much in personal lines. And they can also be used in adjusting the price of personal lines insurance. Now, let me give you an example here. In our Maryland A30 auto policy contract, So we talked about policyholder dividends. There's our Maryland. So if you are a GEICO policyholder and you live in Maryland, this is your policy contract. Now you go all the way to Section 5, conditions, and you're going to see something called number 10, dividend provision. You are entitled to a share in the distribution of the surplus of the company as determined by the board of directors from time to time. So we have that dividend provision in all of our auto policy contracts almost countrywide. Say, but wait a minute, GEICO doesn't pay dividends to our policyholders. Now, USAA may pay dividends to their policyholders. They're mutual. State Farm may pay dividends because they're mutual. GEICO, we're a stock company. We're owned by shareholders. We don't pay dividends to our policyholders. So when I used to work in the department that handled our auto policy contract language, I'd get questions periodically on why do we have this language in there and can we take it out? And the answer to that is, well, no, we can't take it out. We want to leave it in. Not that we have ever paid dividends to our policyholders, and not that we have any plans to pay dividends to our policyholders. But in the event that we ever wanted to do so, then we already have the contractual policy language that would enable us to do so. And there are a couple of states, one of them being Florida, that has an excess profits regulation that requires insurance companies, if they make what is defined by regulation as excess profit, they need to return that profit back to their policyholders. Well, most companies have not ever made an excess profit in Florida such that they've ever had to return money back to their stockholders or to their policyholders. But we have this language in our policy, and we'll keep this language in our policy to give us the flexibility if we ever wanted to do that. But not that we have any plans necessarily to do so. Some regulatory issues on dividends. Prices are set by insurer under competitive rate-making laws. These laws require the excess profits to policyholders in the state. That's Florida. But again, regulators are also concerned with the solvency and equity consideration of insurers. So if an insurer wants to pay dividends, on one hand, a regulator would like the policyholders to get back those dividends, but on the flip side of that, they want to make sure that their payment of any dividends doesn't raise any solvency concerns with an insurer wanting to do that. So if we want to do that from a marketing perspective, pay dividends to our policyholders, regulators are going to be first concerned, well, do you have the sufficient solvency that would enable you to be able to pay those dividends but still maintain the required minimum amounts of capital? And that, my friends, is Chapter 9. Questions? All right. Let's go and do the quiz for this week. And then next week, Chapter 10. And then again, the following week, we will not have class, but I'll put this out in an email when I send out the slides tonight for class. So let's take a quick walk down exam lane here. Make sure this still has me logged in. All right. So question number 1. Capital gains and losses have a significant effect on the decision for an insurer to pay stockholder dividends. Which of the following is the most likely reason for this effect? Say C. Okay. All right, question 2. One way we can meet external capital needs is risk reduction. How can we do that?
D.
D.
D. Purchasing reinsurance. You guys are sharp. Large line capacity provides insurer with what?
A. A.
Agree, A.
All right. New insurance company began operations last year. But we wrote more insurance than anticipated. Well, that's a good problem to have.
B.
B, okay. All the following are examples of external factors. Which one?
D. Rate making.
Rate making, okay. Why do you say rate making?
That's an internal factor.
There you go, all right. You guys are sharp. Okay, financial management practices of insurers differ from those of other industries. B, special income measurement rules, okay. Invest, what?
D.
D, oh my gosh. Which of the following best explains the difference between dividends paid to shareholders and those paid to policyholders? B.
B.
B, okay. Company with significant excess cash. B. Repurchase shares of stock, all right? Okay, number 10. Regulators are concerned with our ability to meet financial obligations as they come due. D, solvency. Right. Let's go next. Primary insurer is able to obtain surplus relief by B, receiving ceding commission. Okay. 12, you can improve our balance sheet values by increasing the value of assets. By doing what? C, sale and leaseback. Uh-oh.
What? I thought it was going to be 100.
The shareholders, dividends, and.
One, let's see.
D.
An acquisition with greater return. So access with greater returns. Greater returns is measured by,
Return on equity.
there you go, return on equity. All right, and that is it for Chapter 9.